Retailers gearing up for the holiday shopping season. Our next guest, though, expects sales to be weighed down by heightened inflationary pressures as non-discretionary prices continue to rise. Bank of America retail analyst Lorraine Hutchinson joins us now. Hi, Lorraine. Thanks so much for being here. I mean, we all know the pressures that are out there, right? From rising prices for things you need, so you have less to spend on things that you want. So talk to us about the holiday season and how all of this plays out. Do you expect people to be buying fewer things or less expensive things or all of the above?
Thanks. Good morning. Our holiday forecast calls for just over 1% sales growth. We do expect people to be using their money more frugally given the pressures they're facing on the non-discretionary parts of their budget. What we're also expecting is on the discretionary side, a lot of their money's been used this year on vacations, eating out, things we couldn't necessarily do a lot of last year. So it makes for a little bit of a tougher holiday for the consumer. We would expect them to be much more focused on value and much more focused on looking for deals this holiday season.
Does that signal that household balance sheets are not healthy, as some banks have told us this earnings season?
Look, our BAC card data and the work of our institute says that the balance sheets still are healthy. It's just we've seen a little bit of pullback in spending in September, and we think that that bodes poorly for the interest in really spending up this holiday season. So we think the consumer's still in good shape, just a little bit more cautious than last year and allocating their dollars to different things.
Lorraine, one key problem in retail ahead of this holiday season, we were just showing the chart on inventory growth. The retail industry is awash in inventory. There is a lot of discounting. In this environment, who sees the biggest gross profit margin pressure, operating margin pressure, and who's at risk of coming out in early January and issuing a major earnings warning?
Yeah, look, we have earnings coming up for retail. We think that they will issue pretty cautious outlooks for 4Q because retail inventories are at all-time record highs. Now, some of this is because they brought in inventory early. Remember last year, the shelves were bare. They stocked out of a lot of goods, so they wanted to make sure they were in stock. But a portion of it is also they were forecasting demand that just hasn't materialized. So we've seen the consumer take a little bit of a step back in mid-June, and then we've seen some slowing since then in September. So we think there is too much. Where we see the biggest risk are those retailers targeting the lower income consumer. We've seen excess inventory levels at retailers like Old Navy, like Kohl's, where the consumer is it's just a little bit tighter. On the good news side, who cleans up those messes? The off-price retailers. They really thrive on problems with the inventory and excess thereof. So we think that retailers like TJ Maxx, Burlington, Ross Stores will be getting a tremendous amount of really high quality, well-branded inventory really starting this quarter.
Lorraine, that's the glass half full part of the equation. I want to go back to the glass half empty part of the equation because we all have been getting this sort of increasingly desperate emails, right, from some of the retailers offering heavy discounting. Some of the retailers, the big guys like Target and Walmart, they've said we're really addressing this inventory buildup. But across the board in retail, do you think that the inventory glut is going to get worse before it gets better? Is the discounting working to work off that inventory?
So we expect the mismatch between supply and demand to peak in the fourth quarter. So we do think holiday will be very promotional. You will get some great deals, and that'll help a stretched consumer. We do expect, though, that as we hit the end of the fourth quarter, so for retail, that's end of January, that they will have worked through it. We think January will be a very heavy clearance period, as most of the retailers are laser focused on exiting the winter season with appropriate levels. When we look to the first half of fiscal 2023, most retailers already had a chance to cut orders. So when spending pulled back a little bit in June and July, most retailers called their factories and their partners and told them to make less. They cut, they canceled. And so we do see some improvement in that in the first half of 23. Now, that doesn't mean that they'll be pristine, but versus 4Q, we think they'll be in much better shape.
Lorraine, one of your top picks is Starbucks. Now, there's this new CEO getting ready to take the helm there. Have you met with him? Have you talked to him about his plan for the company looking out over the next few years?
So Starbucks is actually covered by one of my colleagues. It was one of our top holiday picks. In my sector, my top holiday pick is Tapestry, which owns Coach and Kate Spade.
So well, give us more details on this. Do you think in general that the higher end consumer is going to be more resilient here, and that's why you like Tapestry, or do you think Tapestry is doing something in particular right, even in the luxury universe?
I think a little bit of both, actually. You know, we think Tapestry is one of the few retailers that really did transform during the pandemic. And they took a few actions that we think are really important for the staying power of their earnings. They cut a lot of costs and reinvested those in marketing. They eliminated the bottom 40% of their styles to make their assortment more efficient. And they also added an e-commerce business to their outlet business, which we think added a new customer, a younger customer. So those things combine to give us more confidence in the sustainability of their high teens margins. And with those high teens margins come great cash flow. So we're expecting Tapestry to buy back 7% of its stock and pay a 3% yield every year. And given the stock is near trough multiples at 5 times EBITDA, we think that sets up really nicely into holiday and into 2023.